Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I've shared with you, this is one of the things for when you come into my office, when I meet with clients, one of the things we do when we look at their portfolios is we look at the different holdings they have. Now, and we do Morningstar reports, so whether it's a mutual fund, an individual stock bond, or bond fund, what we typically are seeing, of course, are mutual funds, usually stock and bond mutual funds. And in those, we'll see something that says high yield. Well, when you see high yield, this big red flag goes up, okay? Understanding interest rates have been so low for so long that your typical short-term investment grade bond is not going to give you a really good return. And we see the same thing, of course, with things like CDs, treasuries, savings bonds, fixed annuities. All of those rates are going to be somewhat lower than they have in the past. However, to try to drive that yield, and we were just talking about how high yield bonds have given such great returns here recently, but understand this part of it. What's in there? Why is that? Well, one of them is that it's mainly made up of junk bonds. So when we look on the report, we can see the ratings of the bonds, and anything that's going to be below BBB rating, which is about 95% of the bonds in this particular fund. And this fund, by the way, was rated as like the top fund. It's in the top 10 as rated by U.S. News and World Report, and it's a 5-star Morningstar fund. So as funds go, someone would look at this, or advisor might say, oh, look at this great fund, but understand you're buying junk bonds. And the other thing is long duration bonds. All right, now the duration on this particular one is mainly leaning towards intermediate, but you've also got long-term bonds of about 40%. All of these add interest rate sensitivity, and of course the problems with the junk bonds being that credit quality, right? If you're loaning money to someone that has to pay you more to be able to borrow the money, that means higher risk. Right, so if we're adding risk in our bond portfolio, which is supposed to be reducing risk, yeah, we may be getting some short-term returns, but what is it going to mean over the long term as far as that volatility? If the market goes down, you're going to see these things take a huge hit. And this is one of the things that Carl Icahn talks about quite a bit. And he's got a great, if you Google Carl Icahn, go onto his site and take a look at how he deals with bonds. He talks about how you have these money managers all in this room, and they're all holding these high yield bonds, these junk bonds and these long duration bonds, thinking that when the market turns and they need to get out of them, they're all going to be able to just dump them. The problem being, as he put it, you got a lot of people in a big room with all these bonds that are all going to be trying to sell them at the same time. In other words, they're trying to get out of that big room and through a very small door. There's not going to be much of a market. They're going to drop even faster as a result. And what does that mean? More volatility for you, bigger losses in a down market cycle, and that's what we want to avoid, all right? We want to avoid those big hits, especially when you're at, near, or in retirement. All right, so that's just one of the areas. Take advantage, come see me. I hope this has been helpful for you this week, and I hope you tune in each and every week here on the Retirement Report.